Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
What a week, everybody. This is Sam Barker here with Aaron Kennedy and Kade Sparger on Black and White Market Minute with Life Planning 101. Aaron, tell us about the week. It's been crazy.
Welcome, everybody. Other than today, hasn't been all that fun of a week. I think the NASDAQ was down, four days in a row, and that's the first time that's happened in since April or somewhere around in there. So I think we can honestly say we've been spoiled for several months now. Now, the market hasn't been behaving irrational or anything like that. No huge drops or anything like that. It's just been trickling down. And, you know, that's kind of what we need, tell you the truth. It gets scary when we go straight up. So this was just a little bit of a breather, and it felt good. And then today happened. We have not warranted any kind of interest rate decrease up until today, and what they're going to go ahead and lower it 4 or 5%. I'm not being a little facetious, but we're going to start with a 1%. Maybe not 1, but he said, Mr. Powell said we were off about 1%. So kind of leads me to believe that that's where they're headed. I've never seen us go that fast unless we're in a lot of trouble. So I guess he's trying to play some catch up, which is good. Market loved it. Market's going straight up. All the big industrials, straight through the roof. It's beautiful.
Yeah, well, and it's going to be fun. I don't expect more than a 25% basis cut on the first. He's got all this political pressure that he has to show that he's not falling to. He's got all kinds of stuff that he's supposed to be independent. You know, that's a big conversation nowadays. You know, politics gets done behind closed doors, so there's no telling, except for Trump. There's
just
no telling.
0.25% until he feels the full 1.
I feel he's probably going to start slow and just be very consistent with the cuts. But who knows? You know, markets seem to price in quite a bit of interest rate movements. So
yes,
I think the S&P 500 right now as we sit is up 1.58% today after, like you said, a trickle down all week. So it's been interesting.
Yes,
So
it has.
should we expect an increase going into next week even more, or do you think it'll taper off?
That's a great question. Kind of fits into what I was wanting to say. You know, the market has been Jekyll and Hyde for a long time. And what I mean by that is only one type of stock has really been moving. Recently it was any kind of AI stuff. For that it was Mag 7. But there's a whole ton of the market that just hasn't participated in quite a while. So I'm kind of thinking that all these overpriced stocks, you know, continue to stay overpriced, but leadership kind of changes, and we play catch up with the rest of the market. That's kind of what I'm hoping is going to happen. Now, I don't think the AI craze is going to subside or anything like that, but hopefully we get some other participants, and we're seeing it today. I'm tickled to death. You can hop in here, Sam, but there's a bunch of our portfolio that has some industrial twist to it, a little bit cyclical, more on the shipping side, specifically trucking, and they're all fantastic companies. But, you know, if we're expecting a slowdown in the economy, you know, we're not going to be shipping as many things from coast to coast.
Right.
You know, so the little speech today lit a fire under those companies. I think one of ours is up a little bit north of 6%. Another one was up 4%. We're starting to see, hey, if this economy starts to move, here we go. Things will pick up. So I'm very excited for it.
Yeah, well, and I think the mandate for the Fed is the balancing between labor and inflation. And if we can get, you know, drill baby drill, oil prices down, shipping, like we were talking about some of those industrials, ODFL, the Old Dominion company, it's up, like you said, 6. And then the other one is Packer. It's more of a international company, but it's up $4.25. I mean, if they get more revenues, if the oil prices go down, it gets cheaper to ship. Of course, it's a double-edged sword, because if the economy starts running hotter, then the demand for oil and gas is going to go up, and I don't know.
Yeah, and it's a double-edged sword, especially if our fields out in West Texas are starting to hit the end of growth. It can definitely put some pressure on, but I think we got a lot of leeway, and we got more leeway than people expect. The whole thing with worrying about employment now doesn't make a whole lot of sense to me, because we've been going for quite a while saying that we were going to start eliminating government waste. So we knew a lot of government employees were going to start coming off the board. And that is really what pushed us through the 4 prior years on great employment numbers, just the government hiring anybody that could walk and breathe. All that slack's got to be made up. So there probably is an unemployment problem. But like I said, if our economy's starting to grow, then it can absorb a lot of workers, and we might be caught in this little balancing act where it doesn't really, push prices too high. Just we get back to normal.
Well, and that's just what you use the term, it's that balance. And I think that's just the economy as a whole, because I was going to kind of bring up and ask you what you thought when it comes to when these kinds of things happen, when they make these kind of announcements that spurs the market to do as it does. Are there any sectors or pieces of the market that actually respond negatively to this, like these announcements?
Yeah, when we got lowering interest rates, one of the companies or one of the industries or types of companies that get hurt are anything that relies on investment income,
right, or
interest income. Now, I don't think that's a very big part, but that should definitely get hurt. And on the flip side, our economy. I'll start off by saying our economy's changed, but 2 decades ago, most people lived off of interest income. People were completely satisfied with having their money in bonds and CDs and living off of lower risk investment. And when interest rates go down, that dries up.
Right.
I think our society has changed quite a bit. People have learned to deal with market volatility. We were at 0.25 interest rate for so long. You cannot live off of interest, period. So income, I guess, is not going to be as easy to come by. You're either going to have to take some more stock market risk, which will push markets up higher, or take a lower income.
Yeah, it's almost like a ball rolling downhill, a snowball rolling downhill. You do that and it just kind of compounds on itself, is what it seems like.
That's exactly right.
Well, and companies shouldn't be paying out as much if they can get better borrowing rates and afford them higher growth rates. Is that the right way to think about it? I mean, if you're going to pay out a dividend whenever you can reinvest higher than what it costs you to do your borrowing.
Yeah, absolutely. That's Finance 101. That's, as owners of companies, that's what we want to see. But, it's almost like types of shoes. There's a million different types for comfort or speed or whatever. And we have seen companies make decisions based on their typical investor types. You kind of think about dividend aristocrats, that they try to protect that dividend with everything that they have. And some companies will make decisions to maybe get a little bit higher dividend yield so they can be part of a different index. With what you're saying, it makes absolutely no sense. But they're just going after specific investor types, and I've definitely seen that.
Well, and I think you touched on Finance 101, and I thought it was funny because coming from getting a degree in financial planning and looking at investments and stuff, the amount of stuff you learn in the real world is so different, because when you look at Finance 101, quote unquote, you're right that it has to go streamline with the average investor. There has to be a baseline that it has to cover. But when you get in the real world, there's so many different variables that a school cannot take a part in. And so it's not as simple as saying, this average investor will do this, because then you'll have that outlier that goes and changes the whole situation.
Yes, that's exactly right. And when we're looking at companies and our quality growth, we have some fantastic companies that are doing amazing, growing hand over fist, and to Sam's point, they're kicking out a dividend. And it's like, I don't want that. Once it hits my bank account, if I don't do anything with it, I'm depreciating at whatever inflation is, versus if you keep it on your balance sheet, and if you're growing your capital at 18, 23%, I'd rather you take care of it.
Right.
And I just enjoy the share appreciation. But like I said, lots of different types. It's interesting to walk through this investing world, especially over time, over the last 25, 30 years, and just seeing all the changes that have taken place. And I think investors' appetite for risk has been by far the largest change that I've seen. Going from almost zero volatility through CDs to jumping in the market at 18%. That's a big change.
Just a bit. It really flipped the scales.
Yes,
almost.
It did. But one of the other things I wanted to touch on, where we probably have some wiggle room, with interest rates coming down, it's probably going to unlock a huge part of our economy that's been frozen for a long time, and that's the real estate market. We bring it up from time to time, but if you look across our country, real estate is the wealth of the majority of people, and it hasn't been moving. Nobody wants to take out a 6.5% mortgage, especially if you have one right now that's below 3 or mid 3s. Why in the world would you want to give that up? That mortgage rate is a huge asset. So if interest rates start coming down, we're going to start seeing the largest part of our wealth start to change hands. And if you think about it, when wealth changes hands, most of the time it's for a higher value.
Right, yeah.
So I do see some wealth being generated if we can get interest rates down.
Well, I'm looking at the interest rates right now. The interest rate moves today, so the 3-month has lowered, the yield has lowered, not in absolute terms, but relative terms, has lowered by 1% today, down to 4.19%.
Nice.
That's on the three month. The 10 years down 1.5% to 4.26%, and then the 30-year moved the least today. It's down 67 basis points to 4.89%. So obviously you're not going to get mortgages at those rates, but it's good to see those come down.
But I think when we're thinking mortgage, it's tied to the 10-year. So seeing that coming down, that pretty sure mortgage rates are coming down just the same. So it's something that doesn't need to be frozen, because you can look at it from a lot of different points of view. Hey, I'm going to sell my house. I'm going to flip my house. That is money-making opportunity. If you own your house and you're not changing, but you can refinance, and with your lower interest rate, now all of a sudden you're getting $100, $200, $300 a month extra from not having to pay that on your mortgage. What are you going to do with it? Outside the brilliant people that bring it to Kennedy Financial. You take that out in the economy and you spend it. And, from that standpoint, we're all a big team. The more we all spend, the more our economy grows and the more we all benefit.
I think that's the hard thing that people don't realize as much on when it comes to the market and the economy is you putting in your dollars and spending them drives part of the market. And so when you stop spending, that hurts the market. And so I feel like some people don't realize how big of an impact they have actually on the economy and the market.
Have we ever gone over banking? Just very,
I
very.
worked at a bank. Does that count?
Well, just talking about the movement of money, velocity of money, or whatever. And I'm just going to use easy numbers. These aren't going to be correct, but it gives you a general idea. If I go to a bank and I deposit $100,000, the bank is going to say, "Cool, thank you. I'm going to pay you, what'd you say, 3-month? 4%.
Yeah.
Okay, so that's just easy numbers. They're going to pay me $4,000. The bank says, "Cool, I got $100,000 liability on. I got that as capital. I'm going to go out and loan $500,000. They can leverage that up. That's why this is so important. And what's the bank going to charge? Now, more than likely, right now we're at 6.5 to 8.5, somewhere around there. But let's just say 10. Okay, so now the bank goes out, pays me $4,000, and brings in $50,000. And what did they create? My $100,000 created $500,000. So that's $400,000 net new money into the market. So, yes, your spending makes a difference. It makes a huge difference. Any kind of excess capital that goes into the system grows very fast. And really, the only way to stop that is put it under your mattress.
Right. Well, I want to take a step back, Sam. On that 4% on that 3-month, is that I know you're using absolute and relative, but was that the annual percentage?
Yeah, 4.2% over the next 12 months is what you can currently get. If you get it and roll it at the same rate, you'd get 4.2%.
Okay. Because I was going to say, technically, if it's a 3-month CD with a 4% annual, that's not actually the percentage you get. Working at the bank, that was a common misconception, so I just wanted to make sure, because it's crazy when it comes to...
Yeah, that 4% is assuming you buy it, and in 3 months when it matures, you roll it over at the same rate for the next 12 months.
Oh, okay.
You don't even spend a day outside
Of
that CD. It just automatic roll.
So you were talking about new money into the economy there through the banking system, and it got me thinking about Bitcoin and things like that. Specifically, Bitcoin is up on the week, it's about down 1% on the week, but it trickled down like the market, and then today it's up 3.8%. It's not quite at all-time highs, but it's not far from it. So if we get that velocity of money, I mean, theoretically, who knows what's really going to happen, but the real assets and the digital assets in the world that aren't.
We're going to go down this rabbit hole. This is cool. This is really cool. Okay. If you're Bitcoiner all the way through, your goal is to accumulate, buy, never sell anything. So the goal at the end is to use my Bitcoin as collateral and get a loan off of it. So back to it, if I have a single coin, I'm collateralizing one Bitcoin, $100,000. I know it's north of there. But anyways, it's the same thing. The bank's going to use that as collateral to loan out money. And now all of a sudden we have a collateralized asset that is increasing by the amount of new money creation. We're not quite there where it's dollars for dollars that we're leveraging up 5 times or 8 times wherever we are. But it's coming. Right now, the stable coins are making the news, and this is digital money that banks can use, but it's just supposed to be like the dollar. A lot of the financial industries are fighting to make sure that you cannot have interest-bearing stable coins, which I don't know why. They all translate into dollars, and it's just easier transactions. But anyways, it is front and center in the financial world, and eventually it's gonna all be the same thing. Dollars are dollars, doesn't matter if it's digital form or anything else. But having a collateralized asset that actually increases with inflation instead of decreasing, that's going to be a game changer. So what do they call it? Hodl, hold, keep your Bitcoin, don't ever sell it.
Golden, what is it? Diamond hands.
Oh gosh, that's kitty cats. That's something different.
You threw me off. I had something, but I don't remember.
Well, I was.
Yeah,
I was
kitty.
kinda,
Come on, dude.
I was kind of curious, and you may have said it in your monologue over there. But when yes,
You know, I act like I'm a big time talker.
It's not as bad as last week.
compared to what you normally say, that was a monologue. When it comes to, like, we started out with the big kind of interest rate conversation that happened. Do you think Bitcoin do you see it increasing or decreasing with the news that we just received?
Oh, increasing, and we saw that today.
Mm-hmm.
One of the downfalls or the negatives to Bitcoin is there is no interest rate.
Right.
So, and this is back to basic finance, and kind of think of it similar to holding gold. Okay, this is the same mindset. If I have gold or Bitcoin and I'm trying to hold cash, what do I want to do? Buy gold or Bitcoin and not get that 4%, or just dump it in a CD, get my guaranteed 4%. People are going to go where the income is. But when interest rates get down to zero or closer and closer, that opportunity cost is gone.
Mm-hmm.
So why not own gold?
Right.
Why not own Bitcoin?
Well, and I think the hard part that the average investor doesn't realize is there's always talk about regulating Bitcoin more. That's always been a topic of discussion, I think. And that's why, because it's not as regulated, as scrutinized, that's why it has such volatility and such chance to increase. Correct? Am I thinking of that right? Or
Kinda. You're right. But that's the beauty of it.
right, and that's what I'm getting at is some people, as they push for regulation, some people are like, yeah, it needs to be to where I can do it more easily. It's like, you do understand if they do put those laws in, it's not going to be it's not going to do what it does right now.
Yeah,
I'm getting at.
It's going to take away from the beauty of Bitcoin.
Exactly.
Because right now it is a money for the people, by the people. And once you start getting regulations and once you get big government hands on it, that all goes away.
It's the wild stallion of the marketing world. You don't
Kitty
want
cats and wild stallions. Guys, come on, let's get
on
back
this
point.
episode.
All right. Do y'all have anything else y'all want to touch base on? I know Aaron has a quote-unquote hair appointment to get to. So.
What hair? What appointment? Well, I did want to just kind of mention, I thought it was really cool, really quick. I got to sit on a legacy planning meeting with another firm, got to learn about some of their ins and outs. And one thing that they thought of with legacy planning, we do beneficiaries for investments accounts and whatnot. But one thing that they mentioned that I thought was pretty interesting was they talked about having the conversation with their clients of, does your spouse, who does not normally pay bills, if you passed away today, could they pay the bills? And
you mean like financially or practically?
no, like, do they
effectively?
know how? Do they know where to access it? Do they know? Because one of the stories they said was one client, the spouse passed away, and of course that meant no income was going into their bank account anymore, but all their bills were auto drafting from it, and they didn't know how to turn that off because their spouse always did it. And so
That's a very honest conversation.
it is,
to have.
and it's a hard conversation. And so what they recommended, and what I really did think was really cool, was they were like, here's this sheet of paper with all the account numbers. Basically, this is how you pay the bills. Give it to your spouse that doesn't normally pay the bills, and let them do it for a few weeks. If they can't do it, there's a problem. Because what happens tomorrow? You don't know what's going to happen. If you pass away, you want to make sure your loved ones are taken care of. And we're all about putting beneficiaries on IRAs, on brokerage accounts. But it's that itty-bitty bill. It's the light bill that comes in. And so I just thought that was really powerful.
My spouse, she takes care of everything. Everything. And I would be lost without her. I know that. Trying to get to one of the saddest stories. It was sad. But had that happen, and I mean, the surviving spouse was coming through that, working his way through it, and he was breaking down in her office, and he said, I had no idea who changed the soap out in the shower, in the bathtub. So bills, whatever it is, you're going to be left in the dark if you get left behind by your spouse. And I love the idea of, a to-do list. One more to-do list. One more honey-do list.
And is that not just a good memory to have after the fact? Just
oh gosh,
it's the importance of a conversation.
Yeah.
Having that conversation of what do you do that I don't appreciate you for? Honestly, because like you said, it may be something as simple as changing the soap out, or changing the toilet paper, Aaron. Like that's really it.
You have no idea what's actually done for you. But I love that idea of, if I'm not here tomorrow, this is what you do.
Exactly, and I think it's something that needs to happen a little bit more, because it happens all the time. Because just in that case with the auto drafting, they're getting into a worse and worse situation as it overdrafts their account every time because they don't know that, and it's hard.
That's one thing before we wrap up. I think financial education is so important, and I'd love to see that more in the schools. We need to start early teaching kids how to do this, and even if it is a spouse, and as we're getting closer to Social Security age or whatever that may be, have a good grasp of what's going on.
Well, not even a good grasp, just have somewhat of a grasp.
Some idea.
Don't just go in the dark. Have a little bit for it.
And if not, come. We can help. We can.
Yes, I actually teach a class on it at Texas Tech. So, hey.
Y'all can go around and everybody on here can ask y'all's spouse, what do you do that I don't appreciate you for? But I'm just not going to do that this weekend. I'm going to enjoy my weekend, and I hope everybody else enjoys their weekend. And so y'all have a great weekend, everybody. We'll see you again next week. That's going to be another episode of Black and White Market Minute on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.